Welcome. In this session, we'll apply capital asset pricing model to estimate the cost of equity. And therefore, this lesson should be applied in conjunction with my other lesson on understanding capital asset pricing model, because this one is an application. To apply, you need to understand the concept behind it. What are we going to learn? First, we'll learn how to find information to estimate each of the CAPM variables, how to get information to estimate the risk-free rate, how to get information to estimate beta, how to get information to estimate expected market return. We'll also learn how to make decisions, what type of information to choose and why. Because there's no single cost of equity for a single company at a given point in time. It all depends on the choices of the information we use. Each analyst is different. Two different analysts estimating the same cost of equity for the same company may come up with a different figure. So we'll learn how to decide. Follow me. Welcome. Excel is used as the main tool in this process. So I assume we know how to use Excel. Otherwise, we'll learn how to put the information in Excel and how to calculate each of the variables accordingly. You can refer to my book, Corporate Evaluation: A Practical Approach with the Case Studies, published by Springer. It is available as a hardcover, softcover, as well as ebook from different sources globally. And please do not forget to subscribe, like, share, and press the bell button to get notifications as well as any updates on these lessons to learn more. So we are going to start with the risk-free interest rate. And to recall the capital asset pricing model equation, that means the cost of equity should be equal to the risk-free interest rate plus beta times excess return or market risk premium, the difference between expected market return and risk-free rate. And in this case, we are referring to one of the variables to start with, the risk-free interest rate. To understand risk-free interest rates, we first need to know that the main proxy for risk-free interest rate is government bond. And we cannot simply assume that each government bond is risk-free. It will depend on credit rating. So it's very important to understand credit ratings of governments to be able to determine whether the yield to maturity of a government security should or should not be risk-free. And if it is not risk-free, what adjustments should we make to determine the risk-free interest rate? This table is an example of credit ratings by major rating agencies, Moody's, S&P, as well as Fitch. It's very important to understand that the ratings start with a prime rating, the top, that can be AAA risk-free asset for government bonds. As we go down, the risk increases, which simply means not all governments are the same in terms of credit ratings. And therefore, we should not expect each government security to be risk-free. It should depend on its rating. For example, this is a table of ratings of different countries and default spreads according to a rating. The data is extracted from the Moradans analysis, which I prefer to use. There are different sources from which we can determine default spread of governments. This is among them. You can see, for example, Abu Dhabi as a country is rated by Moody's AA2, and the default spread 0.53%. That's different, for example, from Canada, that is rated AAA. The default spread is 0%. So the yield to maturity of a Canadian bond can be risk-free, but not Abu Dhabi's bond, because there is a risk. The same applies, for example, to Argentina. Rated CA, default spread 12.64%. Therefore, it's very important to understand that when we talk about government securities as risk-free, we simply make a simplified assumption. Adjustments are necessary to determine how much actually the risk-free interest rate is. So we use the returns or yields to maturity of government bonds, and we should note that not every government bond is risk-free. It will depend on credit rating, and to be risk-free, adjustments for default spread must be made. That is the point to note. So the risk-free rate, based on what I've just said, should be equal to government bond yield B, GBY, minus government default spread. So that will depend on what is the default spread of the government, depending on its rating. And therefore, we have some practical considerations to make. First, maturities. Why? Government bonds have different maturities. Some are 10 years, 7 years, 5 years, a few months, 30 years, 40 years, and so on. So which bond maturity to use? Another important point is that credit ratings differ. The rating from S&P can be different from the rating from Moody's or Fitch on the same government. Our question is, which credit rating to use? In this table, we have an example of government bond yields from the Japanese government. Two-year bond yield, 0.03%. 5-year bond yield, 0.25%. 10-year yield, 0.68%. And so on. Each yield is different, depending on maturity. Is there any criteria to choose from? The answer is no standard. But we can consider several factors. One of them is the investment life. We should remember we estimate the risk-free rate simply because we need to estimate the cost of equity. The cost of equity is a discount rate we apply in estimating equity value, or it can be used to estimate the weighted average cost of capital, which is a discount rate to discount future cash flows to determine firm value. These expected future cash flows depend on assumptions we make on how long we expect the future cash flows to be generated. So if we expect short life investment, we expect the time in which we project future cash flows to be short, and therefore probably a shorter maturity bond yield would be preferable. And if we expect to project our future cash flows for a long period of time, then a longer maturity bond yield is preferable. Another important point to note is comparability. Comparability is important because sometimes we value businesses to compare value among different businesses. So to allow valuation comparability, we consider the most available maturity for many countries. And realistically, that is a 10-year bond yield. It is possible to have a 10-year bond yield for many countries, and even for almost every country with bonds, but not necessarily to find a 2-year bond or a 5 or a 7 or other maturities. So normally a 10-year bond yield tend to be used as a benchmark rate for many government securities. It is therefore probably, to me, the most preferable. And this is an example of credit ratings by Moody's, S&P, and Fitch for different countries: United States, Germany, Colombia, Japan, Brazil, and Kenya. We can see in the United States, Moody's and Fitch are consistent in terms of rating, AAA, but in S&P, AA+. For German, all of them are consistent. For Colombia, Baa2, BB- and BB- are different. Japan, A1, A+, are different. So which one to use? Let's consider rating comparison. What do the majority ratings show? For example, to me, in the United States, if the ratings are up to date, I'd consider the United States as a AAA rating, because that's what the majority show. Similarly, for Brazil, I'll consider BB-. There's no problem in Germany because they are all the same. It is also possible to consider consistency. What does it mean? How consistent the government has maintained a particular rating. I understand, for example, from research over the past decade, the United States has maintained AAA. Only this time it has been AA+ to S&P. So reasonably, there could be short-term factors that affected the United States rating and the S&P methodology. So it is reasonable, based on consistency, to consider it as a AAA. Another important point we could consider is expectations. What is the expected outlook associated with ratings? Ratings normally provide outlook, positive, stable, or negative. If we expect a stable outlook, it's a good sign that the future is promising. Similarly, positive outlook. So if S&P is giving AA plus for US and not AAA with a positive outlook, I consider the United States as a AAA rated country. That's just an example. There could be several other different examples. Now, let us use a real example. And in this example, I'm going to use Ecopetrol, a Colombian-based company. The objective is to estimate the cost of equity for Ecopetrol. So we'll start with the risk-free rate, and then we'll proceed with beta and expected market return. The following steps can be followed. The first step is to identify the company's domicile country. And this is because the risk-free rate should be based on the headquarters country of a company. Why? Because it has to reflect company's country risk. Ecopetrol, as a Colombian company, should be affected by what is going on in Colombia. So its cost of equity does not simply depend on expected market return and the relationship between its stock prices and portfolio returns in the market, but also what is going on in each country. So we know the country will be Colombia. Next is now to find the bond yield for a Colombian government. If we are estimating the cost of equity for Toyota, our country should have been Japan. And the bond yield should be based on Japanese government bond. And next, we'll find out the credit rating for Colombian government in order to determine the default spread. And thereafter, we will calculate the risk-free rate. That is government bond yield minus the government default spread. So I'll take you to Excel to show you the data and how to get it, and then we'll proceed from there. This is an Excel data template for the purpose of estimating the cost of equity for Ecopetrol. First, the company is identified, and that's important because we need to identify the domicile country of the company. It's a Colombian company. And the stocks are traded in different markets, but in this case, we'll estimate the cost of equity based on the Colombian market, and the stock index will be Colcap. But for now, we need the variables for risk-free rate. So in this table, we have ratings by Fitch as on June 31st, BB minus, the default spread 2.35, S&P January 23, triple B minus, the default spread 2.35, and Moody's June 2023 Baa2 default spread 2.04. We set the estimation date as on 31st August 2023. And this estimation date is important because it is where we set reference data. And therefore, we use a 10-year government bond yield, which was 10.59 on 31st August 2023. It would be adjusted for default spread because Colombia is not AAA rated, so there is risk. Now, how do we find default spread data? I'll take you online to give you some example based on this company. There could be several sources. I'll only show you some. First, to determine credit rating, you just search by typing the name of a country and the word credit rating. So I'd like to write Colombia credit rating. So I will have several sources. And quickly, you can see different sources with different ratings. One of the sources is governmentbonds.com. And where I can find different ratings for Colombia on different dates. These were 2021, so they are not up to date. I can find the most up to date from other sources. It's very important that we apply the most up to date ratings. To my understanding, the most up to date ratings were 2023, this year. So for example, in tradingeconomics.com, I can find also different ratings for the country. Up to October 2021. And the ratings differ from rating to rating agency. You can also find the ratings from another source, Fitch. According to Fitch, until June 2023, it was affirmed BB+. What about other sources? Bloomberg. According to Bloomberg, this is a news, June 8, 2023. It says, Moody's continues to rate Colombia as investment grade. That simply means should be triple B something. There are no specific details. And this is from IRC, Investors Relations Colombia. It has summarized ratings from different sources, and the most current was June 2023 by Fitch and Mood, and before that we had S&P in January 2023. So we can compare these different sources to determine which one to use, and that is what I have in my Excel summary. Similarly, we can find government bonds by simply typing a country, Colombia, followed by the word government, and then bond. There are several sources. For example, this is worldgovernmentsbonds.com. And you will see a summary of 2-year, 4-year, 5 years, 10 years, and 15 years government bonds for this particular country. And you have the yield. We are concerned about the last. That's the yield we need. In this current date, a 10-year government bond yield 10.474. I set my estimation date 31st August 2023. So I'll be interested to pick a 21st August government bond yield. You can find it from a different source. So let's see. This is tradingeconomics.com. And on 31st August 2023, the yield was around 10.675 based on the historical chart. Another important information we need are the default spreads. I can just write country default spread One of the key sources I prefer to use is the one from New York University Stern by Demoradan. And there is a compilation of different default spreads for different countries almost worldwide. And the good thing with this source tends to be up to date. This one was updated July 14th, 2023. There are different methodologies. They may differ in terms of estimates, but that's not a problem because these are just estimates. So the default spread is presented according to ratings by Moody's in this particular source. And for Colombia, it simply means I'll pick Colombia BAA2, and the spread is 204. If I assume a Moody's rating of BA2, I know it is B minus for S&P and for Fitch. So if I decide to use a triple B minus, then I will find a triple B minus default spread from this particular source. A triple B minus should be lower. That means BB plus something like that, according to the rating equality. So I'll pick a 10-year government bond yield for 31st August 2023. Now, the default spread is my decision. You can make a different decision. I'm going to assume a triple B minus. Someone else can just assume a BAA2 minus. There's no problem. So I'll say that is equal 2.35. And therefore, I'll calculate the risk-free rate as government bond yield minus the default spread. We are done with the risk-free rate. What is next? The next is the expected market return. In our CAPM equation, we are referring to the expected market return, RM. What is it? We know it is the return that is assumed to be the return of the portfolio made of all stocks in the market. That is the CAPM's assumption. Next question is, how is it measured? For CAPM's purpose, it should be an annualized average stock market return. And that should be estimated based on a stock index that fully or represents a portfolio of stocks in which Colombian Ecopetrol is trading. So it is a proxy. Another important question, what index? There are several indices. And what we need is an index that best represents the portfolio of all stocks in the market. Realistically, there is no index for all stocks, but just the best representative. In this case, we'll use Colcap for the Colombian stock market. If we are estimating the cost of equity for a company like ExxonMobil, a US-based company, probably you could use S&P 500 or Dow Jones or NASDAQ. But take note that the choice of the stock index will influence the estimated cost of equity. There are no standards. And that's why we should not expect a single figure for cost of equity for every analyst. It depends on what judgments do we make on estimating each of the CAPM variables. So the process will start by determining the stock index, collecting historical data for the index, calculating the return for the index, that is the percentage change, calculating the average return for the index, and finally to annualize the average to determine the expected market return for the purpose of CAPM. So it's very important to know that each of these is a decision. It's not a science. It can be influenced by subjective aspects. So decide market coverage. It can be a regional index, it can be a country index, or it can be a global index, depending on how you assess the company's presence. In my case, for Ecopetrol, I would prefer to use the domestic market, Colombia. Then we have to decide on historical data, what frequency. It can be daily, weekly, or monthly, it doesn't matter. It's important simply to know that the frequency decision will also determine what expected market return would be, because the results cannot be the same. And then the return, the percentage change between each period, it simply means the current period minus the previous period divided by the previous period. That is the meaning of percentage change. And then we'll calculate average. Average can be arithmetic or can be geometric. The arithmetic average is a simple average. Simply means the sum of all the returns divided by the number of observations in the sample. And the geometric, it simply means the product of all the returns in the sample and square number of observations. -1 is because we +1 to remove negativity in the data, and that is a square, it does not require negative values. And finally, annualization will depend on frequency. It simply means the average return +1 to the power of number of days in the frequency. If it is annual 360 or 365 -1, for weekly 52, and for monthly 12. So let's go to Excel to apply this. This is the data sheet for stock market index. On this particular case, I've decided to use monthly frequency. The index is CAPM, based in Colombia. I consider this to be the best representatives of the portfolio in the Colombian market. It starts from the inception, that was July 31st, 2002. So it is the entire population. It's not just a sample. Some analysts choose a sample 5, 10 years, 20 years. But for a long-term expectation, it is preferred to use the population rather than a sample. Index data can be collected from any source. It can be Yahoo Finance. It can be from the specific stock market. It can be from investing.com. It can be from Bloomberg, anywhere. So after having the data, I'll calculate a change. A change is a return. That means current period return, current period price minus the previous divided by the previous. So the current in this case is 31st August. So that's the starting point. And therefore that should be equal to current minus previous divided by previous. I'll put it in percent. It doesn't matter. In the end, the result should be in percentage. This one will be applied to calculate arithmetic average. If we want to calculate geometric average, we have to add 1 to each one. A change +1. And this is because you cannot calculate geometric average when you have negative values like this. So we add 1 to simply remove negativity. So this one plus 1, it simply means we don't have negative values. And therefore, we can use this for geometric average. And we'll calculate all this throughout. It is important to check the last one because there is no value, can be deleted. The next stage is to calculate average. I'm going to start with arithmetic average, and I've created a template here for market return. The data is monthly. If you're using daily, you have to indicate daily. If weekly, you have to indicate weekly. So arithmetic average is just a simple average. Let's say equal average. And the average of all the changes. And put it in percentage. And geometric average is geomean. So that would be geomean. That means geometric average. And they will use the values with no negative. And because we added 1, that 1 should be subtracted. So minus 1. So we have the arithmetic average 1.03 and 0.83. Take note that these are monthly averages. CAPM requires annual return. That's why we need to annualize each one of them. This is monthly data, so it will be annualized in the power of 12. Should be equal the average monthly plus 1, then to the power of 12 minus 1. The same will apply for geometric average. So I'm just going to drag that formula. It's important to note that geometric average should always be less than arithmetic average. The key differences between arithmetic average and geometric average is that conceptually, arithmetic average assumes that the observed prices are dependent. Sorry, are independent. They don't depend on each other. That is arithmetic. What happens today does not affect tomorrow. The price today does not influence the price tomorrow. Geometric is the opposite. That what is going on in the market today will influence what is going to happen tomorrow. So they are dependent. The choice of whether you are going to apply geometric or arithmetic is relative, subjective. Realistically, a geometric average is more realistic because truly prices tend to be dependent. So what is next? Next is to estimate beta. Beta simply means a measure of market risk. It is a measure of the relationship between stock returns and market returns, which simply means we'll need 2 data sets. We'll need the market index data as well as the stock price data based on exactly the same sample, the same frequency, and the same estimation date. So let's first talk about the concept and the process of determining beta. First, what does it measure? It is a systematic risk assumed by CAPM. So it's a measure of market risk generally. The second question, how is it measured? It is the sensitivity of individual stock returns to market returns. So what is the process? One, we have to determine the market in which the stock trades. For example, in this case, Ecopetrol's stock, the market is determined as the Colombian market, and the index should be Colcap. If I was estimating the cost of equity of Chevron Corporation, a US company, I could use the US market. In this case, I could say S&P 500 as the index. We have to determine the sample size and the frequency. We have to collect historical data. We have to calculate returns and calculate beta. These are the 5 key steps. So on the stock market, we need prices of the stock as well as the market index. Which criteria to decide the sample? There's no criteria. Although normally it ranges between 2 years and 5 years. Similarly, the frequency can be daily, weekly, monthly. Doesn't matter. It's only important to note that the choices would make a difference. Someone who is choosing a monthly frequency and someone who is choosing a daily frequency, the outcomes can differ. But there are no standards. And then we'll collect data. I'm going to define the stock price for a company as Y, T, because it is historical. T means time. And the market index as XT. Normally we use close or adjusted close. In this case, I will use close. The adjusted close includes normally adjustment for dividend. But not all companies pay dividend. Then we'll calculate the return. The return is simply a change between the current and the previous periods, depending on the frequency. It can be monthly return, daily return, or weekly return. And finally, we'll calculate beta. There are several methods. We can use a regression analysis whereby the stock is a dependent variable, YT, and the market index is independent variable, XT. So beta is a coefficient to be estimated. It is a measure in which the stock responds to market. We can use covariance-variance ratio. That means the covariance between market returns and stock returns divided by the variance of the market return. So it's a simply a measure of co-movement of the stock returns due to change in stock market volatility. So conceptually, it is a measure on how market risk affect the stock. That's why the variance of the market is a denominator. It can also be measured as simply a change in stock return to change in market returns. That means a linear relationship between stock returns and market returns. Each one of them can be used because the outcome should be exactly the same. So what is next? Next, I'm going to show how to do this with Excel using Ecopetrol's data. This is the dataset section for estimating beta. In this case, I'm using daily frequency. Someone else could use weekly or monthly. It doesn't matter. This is just an estimate. Remember, this is evaluation. It's not necessarily science. Science and art. So first we have the sample. In this case, I apply 3 years almost from 2020, August 3rd, until 31st August 23. Can use 5 years, no problem. 4 years, 2 years, there's no problem. There are no standards regarding the sample. CAPM is the index. X. EC is the stock, means Ecopetrol. Y. So first calculate a change. Change means the return. In this case, there will be daily returns because the frequency is daily. The return simply means a change from one period, current minus previous, divided by previous. And this will apply to Ecopetrol. It is Y, so I can just drag that because the formula is the same. And then it will be calculated throughout. Take note, the last one should not have anything, because there's no data in the previous observations. So what is next? Next is to calculate beta. I've created a template here for calculating beta using 3 methods: covariance, variance, the slope, and the scatter or regression. So I'll start with covariance. That is the covariance between the stock returns and market returns. So simply write equal covariance of the population, so covariance P, and it will be between the market returns, select all, separate with a comma or semicolon, depending on the setting of your Excel, and then select the stock return, close bracket, divide by the variance of the market. So it is going to be variance P, variance of the population. And in this case, I'll select the market. The market is CAPM. So market returns are going to be divided. And then you have the beta, 1.3336. Second, you can use slope. Say equal slope. And this is the slope of the stock divided by the market. So first select the stock, separate, and then select the market. If your calculations are correct, the result should be exactly the same. And then we can apply the scatter diagram. In the scatter diagram, the scatter is a measure of correlation between 2 variables. In this case, it is a stock index returns and Ecopetrol returns. So to apply a scatter, I'll select both the market returns and the stock returns. And I will choose where to put the scatter. I'm going to put it here. Say insert, scatter, choose the scatter graph, n of the scatter graphs. That is our scatter graph. Yt is a dependent variable, and that's how it should appear. There is no data or regression function here. So we are going to add a regression function by going to quick layout. In quick layout, we choose the one with fx, that means with a function with an equation. So the equation will appear like this. I'm going to move it somewhere there. It says y equal 1.336x, which means x is the market return, and therefore 1.336 is beta. That is the coefficient for beta or market risk, which is the same as what we have from the other methods. So let's just put it here. It is exactly the same. So we are done with beta. What is next? Next is to calculate the cost of equity. But which variables do we need? We need the risk-free rate. We already have the risk-free rate, so I'll say just equal the risk-free rate. And then we have beta, that is equal 1.336. And then we have market return. The choice can be either geometric or arithmetic. It does not matter. I'm going to use geometric. Equal . So cost of equity should be equal risk-free rate plus beta times expected market return minus risk-free rate. Put it in only 1, 2 decimal places, okay. So that's how we estimate the cost of equity. Two things to take note. First, estimation is not universal. It depends on what decisions we make. Do not expect a single cost of equity from different analysts. For example, the choice of risk-free rate can differ from one analyst to another. The choice of expected market return can differ depending on how they choose data frequencies and sample periods, and even which type of stock index they choose. Choosing S&P 500 or NASDAQ or Dow Jones for a US-based company would give different results. Beta can differ depending on several factors: the sample period, frequency, and the market itself. So take note, there's no single cost of equity. It's just an estimate. As long as you follow the steps correctly, no problem. Understand CAPM. Thank you very much for today. I hope that is useful. Please do not forget to subscribe to learn more from my channel. Bye-bye. Thank you very much.